Good afternoon, traders. This is Tony D from the easyMarkets dealing room. Hope everyone had a good Anzac Day, but the market was very aggressive yesterday. A few pairs starting to move quite sharply whilst we were away from the desk. You saw the Aussie dollar continue to test new lows under 76. Dollar yen break 108, 109, all the way up to 109.50. Dollar index, dollar index hitting fresh year highs above 91. And you've got the US 10-year interest rates breaking 3% for the first time in 4 years, and the US 2-year interest rate breaking 2.5% for the first time in 10 years. So, yeah, this is the sort of environment where the US dollar should do really well, and it is doing really well. It's just whether the impact that you're getting from such large moves in the US bond market will overflow into the rest of currencies for forever, or it's just going to be short term. So basically, if those yields settle down, then the reason for the US dollar being so strong will probably be settled down as well, because it's not really like there's a market shift here. It was just a timing situation. Positionally, the US dollar hadn't had a rally for a while, and then we got a reason for it. And so a lot of people get caught short the dollar, mainly in the euro as well, and the pound. But whether it will continue for longer than 1 week is really the big question, because when the treasury yield settle down, the market will go back to its normal sort of flow, and that is US dollar selling quite comfortably. So if you're looking at pairs though, which are also had a result of this move, is if you look at when the US yields broke 3% for the first time, we saw close to 600-point drop on the Dow. It has stabilized and bounced a little yesterday, last night, but the market's looking fairly fragile, fairly negative here in the US stocks. It can get lower. If you look at the wedgings that's happening, these previous highs, this does make it harder for you to get excited to buy on the dip each time. And if the support was to break through on the downside, so much room here for the market to pull back that it's you have to be open to the idea of further pullbacks. Now, this generally is going to lead to also the safe havens doing well, so that would be yen strength, and Swiss strength, and gold strength. But in the current market, if it's led by the US yields going up, then dollar yen, you can see, is quite strong. So it's not the same as the usual scenarios. But if stocks start to fall more aggressively, yeah, you definitely see the yen come back into favor, and this short-term rally, which is due to yields, can get pulled back very quickly. So it does leave the pairs like the Aussie more vulnerable though, because it is linked a little bit to global sentiment, and we already see we're on the way back down towards that 75 level, and it wouldn't be a huge stretch to see us break that if the conditions were negative enough, and this could happen in very short time. You see the moves back below 73, 75 does open the door to 73, and we have been as low as 70 cents back in 2015, and this is back when oil was sub $30. So that's the sort of environment that we're in to get oil to get the Aussie that low. But at the moment anyway, the sentiment towards the Aussie is very bearish. We need to see a little bit of stabilization before we can talk about the market going back higher. Look, for those who are wanting a little bit more in depth, then tonight we do have a webinar that I'll be hosting on the fundamental outlook for May, and also a little review on what's happening here so far in April. You can get access to that from the link below, and also if you're a client, you'll get an email shortly.